Are you guilty of believing in some common money myth? Let's find it out together. You might be surprised that many of the financial truths we've been told are actually myths that can hold you back from achieving your financial goals. So let's get to the bottom of this and challenge some conventional wisdom. Let's start with the myth that I have enough money, I don't need to budget. One of the biggest misconceptions out there is that budgeting is only for people who are struggling financially. However, budgeting is crucial for everyone, regardless of income level. Think of a budget as a roadmap for your financial journey. It helps you to navigate towards your financial goals without any unnecessary detours. Even if you are comfortably off, without a budget, it's easy to lose track of where your money is going. You have to know exactly what your income and expenses are. Most people think they know them without writing them down at all or tracking them, which is a huge mistake. Only 41% of Americans use a budget, yet those who do are often more financially stable. Budgeting helps you to identify unnecessary expenses, allocate funds towards your goals, and prepare for emergencies. Remember, even the wealthiest individuals use budgets to maintain and grow their wealth. Without a budget, it's like sailing without a map. You might end up somewhere, but it won't necessarily be where you want to go. You can also use the financial tracker I have created, which will make your budgeting journey easier. Now that we have busted the myth about budgeting, let's tackle another financial misconception that might be holding you back. The idea that all debt is bad. And while it's true that carrying a balance on your credit card or high interest loan can cost a lot, but not all debt will hold you back. In fact, certain types of debt, like mortgages, can actually help you move forward in life and achieve your personal goals. For instance, taking out a mortgage to buy a home can be a smart financial decision, as it allows you to build equity over time. Plus, the interest rates on mortgages are much lower than those on personal loans or credit cards, and the interest may even be tax deductible. Let's say you buy a home for $500,000 with a 10% down payment. So your down payment is $50,000. If the price of that house increases by 10% over the years, the new value of the house is going to be $550,000. This means that the value of the house increased by $50,000 in total. This $50,000 gain is a 100% return on your initial investment, because your down payment was $50,000. This example illustrates how debt can lead to significant financial gains, especially when the debt is used to purchase appreciating assets. So, not all debt is detrimental. What matters is how you manage and leverage debt. Shifting from debt to credit cards, let's debunk another widespread myth. Credit cards are evil and should be avoided. And while it's true that mismanaged credit card debt can get easily out of control, credit cards themselves are not the enemy. When used wisely, they can be actually very powerful financial tools. The key is to use them responsibly. Paying off your balance in full each month ensures that you avoid interest charges. Additionally, it's important not to exceed 30% of your credit limit, as doing so can negatively impact your credit score. The average credit card interest rate is around 20%, but this only applies if you carry a balance. By paying off your balance each month, you avoid interest altogether and build a strong credit score, which can save you thousands on larger loans. In 2022 alone, Americans earned around $15 billion in cashback and travel rewards. By avoiding credit cards entirely, you would miss out on these perks. So, instead of avoiding credit cards, focus on learning how to use them to your advantage. They aren't evil. They are tools that can either benefit or harm you, depending on how you manage them. Speaking of financial tools, let's debunk the myth that you need to be rich to invest. This myth is like thinking you need to be a professional chef to cook a decent meal. It's simply not true. I'm no professional chef myself, but my chicken parmigiana is delicious. Similarly, you don't need to be rich to start investing. But where did this myth come from? Historically, investing was associated with wealth because of high entry barriers, like minimum investment amounts and hefty brokerage fees. Like you had to pay $50 or even $100 to trade. But the landscape has changed over time, because online platforms have allowed people to start investing with very little money. According to a survey, 61% of Americans have money invested in the stock market. The earlier you start investing, the better, as even small, consistent investments can grow significantly over time due to the power of compound interest. Whether you are investing spare change or a portion of your income, The key is to get started as soon as possible and to stay consistent. So you don't need to be wealthy to build wealth, you just need to start. Now that we have established that anyone can start investing, let's confront another fear that often holds people back: the misconception that investing is too risky. While it's true that all investments carry some level of risk, not investing can be even riskier due to inflation. Because inflation erodes the purchasing power of your money over time, meaning that your savings buy less in the future than they do today. This means that by not investing, you're essentially losing money every day. By diversifying your portfolio and having a long-term perspective, you can mitigate many of the risks. This was also supported by JP Morgan, who reached the conclusion that holding a diversified portfolio over 20 years has historically returned positive results, regardless of any market fluctuation. Investing in a diversified mix of assets like bonds, stocks and real estate can spread out risk and reduce the potential for loss. Additionally, using dollar cost averaging can help manage market volatility. With DCA, you invest a fixed amount of money regularly, which means that you buy more shares when prices are low and fewer when prices are high. This strategy helps you to smoothen the fluctuations in the market and reduces the impact of market timing on your investments. The goal isn't to avoid all risks, but to manage them smartly. Now, let's dispel another myth that's often used to explain why some people are wealthy. Most millionaires inherited their wealth. Contrary to popular belief, the majority of millionaires are self-made. According to a study, 88% of millionaires are first generation, meaning they did not inherit their wealth. These self-made millionaires typically share common traits: a strong work ethic, financial acumen, and a disciplined approach to saving and investing. Their success stories highlight that financial success is more closely linked to personal behavior and a willingness to take calculated risks than to family background. Interestingly, while less than 20% of Americans are self-employed, they represent around 2/3 of the country's millionaires. This stat underscores that entrepreneurship is a significant path to wealth creation. I personally find it also very interesting that maintaining wealth across generations proves to be very challenging. Only about 30% of affluent families preserve their wealth into the second generation, and only around 10% manage to extend it beyond the third. Speaking of building wealth, let's address the myth that you need a high income to become wealthy. It's easy to think that only high earners can become wealthy, but that's not necessarily true. Wealth is equally about how much you save and invest than how much you earn. According to the book The Millionaire Next Door, many millionaires live modestly, save diligently, and invest wisely. They often live below their means by avoiding lifestyle inflation. For example, if you save $200 a month from age 25 to 65 with an average annual return of 7%, you could end up with over $500,000. The takeaway: it's not only about how much you make, it's also about how much you keep and invest. Even if you earn a modest income, consistently saving a portion of your earnings and investing it can lead to a substantial investment portfolio over time. The key is to start as early as you can and be consistent with your investments, taking advantage of compound interest. It's easy to get caught up in these misconceptions, but understanding the reality behind them can help you to make better financial decisions. Remember, financial freedom is within reach for everyone, and breaking free from this myth is a good step in the right direction. By applying what you've learned today, you can start building a more secure future, regardless of your current financial situation. And this was it for today. Thanks for watching, and don't forget to like, subscribe, and watch another video. See you in the next one. Thank you. Bye.